In the first 6 months of 2026, American companies announced 185,894 job cuts. That is more than 1,000 people every single day, weekends included, holidays included, for 181 straight days. And for 4 consecutive months, the number one reason companies gave for those cuts was the same 2 letters, AI. Here's what makes this strange. The companies cutting the deepest are also spending more money than at any point in history. One company laid off 8,000 people and hired 7,000 new ones for AI roles in the same 12 months. So the money didn't disappear. Payroll money never disappears. It moves, and almost nobody is tracking where it actually lands. We traced 6 months of layoff filings, earnings calls, and hiring data to follow every dollar from pink slip to balance sheet. Because wherever you work, tech, finance, retail, healthcare, your paycheck now sits somewhere on the map we're about to draw. Today's flight plan, the layoff machine, the official story, the money trail, the people, and your route through it. Wheels up. Chapter 1, the machine. Before we follow the money, you need to see the scale, company by company, number by number. The numbers come from public trackers that log every announced cut, press releases, regulatory filings, and verified reports. Announced, not rumored. January through June, 185,894 positions eliminated, one of the heaviest 6-month stretches on record. The single biggest cut came in June. Oracle, 21,000 roles, roughly 1 in every 8 employees, gone in one announcement. Support teams, legacy software divisions, regional offices. In its messaging, the company pointed to one priority absorbing the savings: AI infrastructure. 21,000 salaries versus 1 buildout. That trade, people out, compute in, is the pattern you'll see for the next 20 minutes. Here's the detail most coverage skipped. Markets rewarded it. Shares climbed in the days after the announcement, not despite it. Remember that reaction. It explains almost everything that follows. Cutting jobs in 2026 isn't punished. Framed correctly, it's rewarded. Case 2 Meta. 8,000 roles eliminated across trust and safety, recruiting, and middle management during the first half of the year. But the tracker shows the other half. In the same window, Meta hired roughly 7,000 people into AI-focused roles. Now the math nobody says out loud. Those 7,000 hires likely cost more than the 8,000 salaries they replaced. So this wasn't shrinking to save money. It was a swap. One workforce traded for a smaller, more expensive, more specialized one. Same building, same budget line, different people. If you only read the layoff headline, you saw half the transaction. Case 3. Intuit. 3,000 employees, 17% of its workforce, cut in a restructuring the company tied explicitly to AI. This one wasn't hidden in footnotes. Leadership publicly framed the cuts as reallocating money and headcount toward the AI opportunity. 3 companies, one stitch running through every filing. The cuts weren't framed as retreat. They were framed as funding for AI. Add Microsoft, which confirmed thousands more cuts in early July, while simultaneously committing record sums to AI data centers. Then the long tail, hundreds of smaller firms, startups, agencies, software vendors, each announcing dozens or hundreds of cuts, citing efficiency. Now widen the lens, because this stopped being a tech story months ago. Watch what happens when we map it by industry. Technology leads the count, but finance is closing fast. Banks, insurers, and fintechs cutting operations, support, and compliance roles at scale. One widely cited projection: global banks could shed as many as 200,000 positions within 5 years as AI absorbs back-office work. The roles going first aren't traders or bankers. They're the invisible middle: reconciliation, document review, claims processing, first-line customer support. Which brings us to the streak. March, April, May, June, for straight months where AI ranked as the most cited reason for American job cuts. Within this year's total, trackers tie roughly 101,743 cuts directly to AI as the stated cause. Pause on that. More than half of this year's announced cuts carry the same explanation. In the tracker's history, That's unprecedented. For decades, layoff paperwork blamed the usual suspects: recessions, mergers, offshoring, restructuring. Vague words, deniable words. Nobody's resume argued with them. In 2026, companies volunteer a specific technology by name, and that choice, naming AI, is stranger than it looks. Because we cut jobs for AI is not a confession. In this market, it's a pitch, and investors are the audience. Announce plain cost-cutting, and you sound like you're struggling. Announce an AI transformation, and the same cut sounds like the future. Same severance checks, same empty desks, entirely different stock reaction, which raises the question this whole investigation hangs on. When a company says AI took those jobs, is that an engineering fact or a financial story? Chapter 2 finds out. Chapter 2, the official story. To test it, we compared what companies said with what their own numbers actually show. Start with language. On earnings calls this year, mentions of AI alongside words like efficiency and headcount hit all-time highs. Executives learned a simple equation. AI plus cost discipline equals a higher multiple. The words themselves became worth billions in valuation. That doesn't make every claim false. It means every claim now carries an incentive. So let's separate the three real drivers. Driver 1, the hangover. Tech roughly doubled its hiring during the pandemic boom, then spent years quietly correcting that overshoot. Driver 2, expensive money. When borrowing costs money, headcount is the fastest expense to cut and the easiest to justify. Driver 3, actual automation. Real tasks, support tickets, basic code, document processing genuinely moved from people to software this year. Here's the honest read. All three drivers are real, but only one of them makes a stock go up when announced. So, AI did it is partly true, partly the most profitable sentence in corporate America. But those salaries were real money. Welcome back. Before the money trail, one more test of the official story, because it has a measurable weak spot. If AI truly replaced those workers, you'd expect AI products generating massive new revenue. At most firms, that line is still small. Several economists reviewing the streak reached the same conclusion. Some of these cuts are ordinary belt-tightening wearing an AI costume. Why the costume? Because restructuring invites hard questions about management. AI transformation invites upgrades from analysts. Same jacket, better story. But dismissing everything as theater would be its own mistake. Because in specific corners, the automation is completely, measurably real. Precedent. From 2024, one fintech reported its AI assistant handled the workload of 700 human support agents. By this year, major tech firms reported meaningful shares of new code written with AI assistants. Fewer juniors get hired to write it. Insurance claims, invoice matching, legal document review, expense auditing, quiet workflows where software now does what entry-level teams once did. So the honest verdict on the official story, part narrative, part reality, and the ratio differs at every single company. For you, the ratio matters less than the direction. Both the narrative and the reality point the same way, fewer entry rungs. The ladder still exists. The bottom rungs are being sawed off. That's the structural fact underneath all the corporate language. Now the question that started this investigation. 185,000 salaries stopped flowing to households. Money that big leaves footprints. Chapter 3. We follow those footprints into the largest infrastructure spending spree in the history of private business. Altitude check. This is where we fly by instruments. Just public numbers, simple math, and no adjectives. Ready? Calculators out. 185,000 jobs at an average loaded cost near $130,000 each. That's payroll, benefits, taxes combined. Multiply it out, roughly $24 billion a year in wages that stopped arriving in mailboxes and started staying on balance sheets. $24 billion sounds enormous. Now watch it shrink. Because the company's AI construction budgets make it look like pocket change. In 2025, the four biggest cloud companies alone spent roughly $410 billion on capital expenditure, mostly AI. For 2026, their combined plans reach $725 billion, up 77%, in 1 year. For companies, $750 billion. Stack on the mega projects. One AI infrastructure venture announced in 2025 carried a $500 billion multi-year price tag. This is where the money physically went, not into a void, into concrete, steel, cooling systems, and racks of specialized silicon. A single top-tier AI chip costs about as much as a compact car. A serious training cluster needs tens of thousands. Then electricity. A large AI campus can draw as much power as a mid-sized city every hour around the clock. Hold this before and after in your head. Before, a floor of salaries. After, a hall of servers. Same corporate budget line. That's destination 1 for the money, compute. But our trace found 2 more channels, and they're less discussed and more revealing. Destination 2, buybacks. While cutting headcount, large American companies repurchased roughly $1 trillion of their own stock in a year. A buyback shrinks the number of shares, which mechanically lifts earnings per share, the exact metric executive bonuses often track. Follow the loop. Salary savings improve margins. Margins fund buybacks. Buybacks lift the stock, and stock pays leadership. Perfectly legal. Rarely explained. To be fair, buybacks also reward every retirement account holding those shares. The money reaches millions of people, just not as paychecks. Destination 3, the talent war. Because while most workers faced cuts, one tiny group watched its price go vertical. Top AI researchers now command packages worth millions per year. Some reported offers reached 9 figures. For one single person. Remember the 7,000 for 8,000 swap? Run the compensation math, and the smaller workforce likely costs more than the one it replaced. That's the deeper shift. Payroll isn't shrinking so much as concentrating. Fewer people, each carrying more money, more leverage, more risk. Now put all 3 destinations on an actual map, because the geography of this money migration is its own story. Salaries used to cluster in expensive coastal metros. Data center dollars flow somewhere else. Northern Virginia, Texas, Ohio, Iowa, Georgia. In these counties, the layoff economy looks like a boom. Land deals, construction contracts, tax revenue, and electricians earning 6 figures. One economy's severance is another economy's groundbreaking. Whether this wave hurts you may depend mostly on your zip code. One catch. A data center employs thousands during construction, but often only dozens to hundreds once it's running. Quiet buildings. See the conversion? Recurring wages, money that circulated through groceries, rent, and main streets, became one-time construction and imported hardware. Economists will debate that trade for a decade. A salary spends locally every month. A server rack mostly doesn't. And the market's verdict? Companies pairing layoffs with AI spending plans were, on average, rewarded with higher valuations this half. Zoom out, and the concentration is historic. A handful of AI-heavy companies now drives an outsized share of the entire market's value, which creates a strange loop. If you hold an index fund, the layoff economy has quietly been paying you, too. So the ledger closes. Missing payroll became compute, buybacks, and concentrated talent. Every dollar accounted for. Case closed, almost. Because a ledger shows where money went. It cannot show what happened to the people the numbers used to be. 185,000 is a statistic. One is a Tuesday morning calendar invite from HR with no agenda line. What happens in the 12 months after that meeting? We pulled the survey data, and some of it genuinely surprised us. No doom, no pity, just the honest trajectories, who recovered, who didn't, and the single variable that kept separating them. That variable is worth more than any severance check, and it's sitting in a Gallup poll most people scrolled past. Chapter 4, The People. Here's what public data, not anecdotes, not viral posts, says happens after the badge deactivates. The cuts concentrated in specific functions: recruiting, customer support, quality assurance, marketing operations, and layer after layer of middle management. Notice what that means. Entire functions were eliminated, which means performance often had nothing to do with who went home. What departure looks like: typically 8 to 16 weeks of severance in tech. Healthcare coverage for a few months, then silence. Then the search. Recent surveys put the median hunt for laid-off tech workers around 5 to 7 months this year. The landing split 3 ways. Some match their old salary, many accept a step down, and a growing share changes industries entirely. For those who stepped down, offers commonly landed 15 to 25% below the 2022 peaks. That's mortgage math changing in real time. And the quietest statistic, a meaningful slice never returns to their old industry at all. Not failure, a forced, permanent recalculation. Now the pattern inside the pattern. Gallup polling found a sharp divide between workers who used AI tools and workers who didn't. Workplace AI use has roughly doubled in 2 years, yet a majority of American workers still report rarely or never using it. Here's our read, marked as analysis. Non-users cluster in exactly the routine roles automation reaches first. The exposure stacks twice. Meet a composite from the data, call her the support lead. 11 years, 3 promotions, laid off with her entire department. She spends 5 months learning the tools that replaced her team, then gets hired to manage those exact tools. Same industry, new leverage. Another composite, the QA analyst. Month 7, hundreds of applications. His task list was automated. His new skills aren't visible yet. Same layoff, 2 trajectories. The variables the data keeps flagging, which skills you can prove, where you live, and honestly, timing luck. Let's retire one narrative permanently. This isn't about lazy workers. These were people who did everything right while the rules changed mid-career. History offers a rhyme. ATMs didn't end bank tellers, spreadsheets didn't end accountants. Job counts eventually grew, but the jobs changed shape. The honest difference this time is speed. Past transitions took a generation. This one is compressing into a resume gap. And zoom out for balance. National unemployment remains moderate as of June. This is a reallocation, not a collapse. Precision matters. So the honest question isn't, is it bad? It's, where did demand move? Chapter 5. What's actually hiring right now? Chapter 5. The other side of the ledger. Because the same trackers logging layoffs are also logging where hiring accelerated. The World Economic Forum projects 92 million jobs displaced by 2030 and 170 million created. Net positive on paper. Treat that as a forecast, not a promise. Nobody's mortgage gets paid by a projection, but the created jobs have visible categories. Category 1, implementation. Companies bought AI tools faster than anyone learned to run them. Someone has to make this stuff actually work. That means AI operations roles, workflow builders, and integrators, especially for small businesses that can't afford a data science team. Real market rates. Freelancers currently charge $500 to $1,500 per custom chatbot build for local businesses. Per bot. Category 2, training the machines. Expert marketplaces now pay doctors, lawyers, coders, and writers to teach AI systems their judgment. Rates vary wildly by expertise. Routine annotation pays little. Deep domain review pays professional hourly rates. Skill still sets the price. Category 3, oversight. Someone must verify what AI produces, auditing outputs, catching errors, handling compliance. Trust became a job description. Category 4, the physical build-out. Every billion in AI CapEx needs electricians, HVAC techs, welders, and grid engineers. Human hands. Near major data center corridors, experienced electricians now clear 6 figures, with overtime, sometimes well past it. The trades are booming. Behind them, the energy sector, power generation, grid upgrades, cooling systems. The build-out's bottleneck is electricity, and electricity means jobs. Category 5, the human premium. Healthcare and skilled care still top every official growth projection. Some work resists automation by nature. See the pattern? The hiring clusters around the money flow. Build the machines, run them, apply them, check them, or do what they can't. Concrete example. Yesterday's support agent, retrained, becomes today's AI support operations lead, managing the system that answers the tickets. Reality check, because we don't do hype here. Most of these jobs pay ordinary wages. Solid. Survivable. Not lottery tickets. But there is a documented premium. PwC found workers with AI skills earn substantially more, a gap that widened to 56%. And AI skill requirements are spreading into ordinary postings, marketing, finance, logistics, HR, far beyond anything labeled a tech job. One catch the data keeps confirming. The premium goes to people who can demonstrate use, not list a certificate. Proof beats paper. Which raises the only question that matters for the next decade of your income. Who actually captures these roles? The dividing line in the data isn't age. It isn't a degree. It's a habit, one this next number makes brutally clear. Time for the final altitude check. One statistic separates the workers being cut from the workers being hired. Instruments on. Altitude check, final approach. No adjectives, no fear, for numbers that define the 2026 skill gap. Number 1. Usage. Gallup. The share of employees using AI at work several times a year has nearly doubled since 2023. Number 2 is the one that should stop your scroll, because the workers not using these tools share one statistical fate. Reported this July, employees who never adopted AI tools were significantly more likely to sit in roles that got eliminated. Marked as analysis. That's correlation, not karma. Routine-heavy roles both discourage AI use and attract automation. The exposure compounds itself. Number 3. The gap is trainable. Closing it takes focused hours, not another degree. That's unusual for an economic dividing line. Because using AI concretely means 3 things: drafting with it, analyzing with it, and automating one repeating workflow you already own. Number 4. The time math. 1 deliberate hour a day for 90 days puts you ahead of most of your industry, measurably. Now the honest caveat: AI skills are not immunity. Nothing in this economy guarantees anything. Anyone promising certainty is selling something. What skills change is odds, moving you from the statistical half getting cut toward the half getting recruited. Odds are the game. Hiring surveys confirm it. Candidates who demonstrate real AI workflows in interviews now outrank credentials alone in many screening processes. For numbers, one conclusion: the gap is real, measurable, and still open. So here's exactly what to do with it. The verdict: in one breath, the money never vanished. It moved from paychecks into servers, buybacks, and a smaller, pricier workforce. And AI took the jobs is both engineering fact and financial story. Companies cited AI. The full truth is Messier. Both point one direction. That direction isn't doom. It's turbulence, survivable, navigable turbulence. And turbulence has procedures. Here is your flight plan. 5 steps. Step 1. Audit your exposure. List your weekly tasks. Routine and digital means exposed. Judgment, relationships, and hands means ballast. Ignore your job title. Automation doesn't read titles. It reads tasks. Your exposure is the percentage of your week that's repeatable. Step 2. Become your team's documented AI user within 30 days. Pick one workflow, improve it visibly, and show your manager. Step 3. Build one artifact, a working automation, a custom bot, a before and after time study. Something a stranger can see. That artifact is currency twice, proof in interviews, and a sellable service. Remember, $500 to $1,500 per bot build. Step 4. Aim at the flow. Implementation, oversight, training data, the physical build-out, or care work. Demand lives where money lands. Step 5. Build runway. Months of expenses in reserve. Not investment advice, altitude. Pilots don't do acrobatics at low altitude. The flight plan. Audit exposure. Become the documented user. Build an artifact. Aim at the flow and hold altitude. Screenshot it. Next on Profit Pilot. The custom GPT bot gold rush. Real rates, real clients, and the honest math. Subscribe so you're aboard. Standard disclaimer. This is educational analysis, not financial or career advice. Figures reflect public reporting as of early July 2026. Where companies cited AI, we report the citation, not a verdict on their true motives. Revisions happen. Check the description for sources. 185,000 jobs, 24 billion in payroll, 400 billion in machines. Now the map is yours. The economy didn't end. It banked into a turn. The pilots who saw the turn coming are already adjusting course. This has been a Profit Pilot investigation. Thanks for flying with us. See you on the next flight plan. Cleared for takeoff.